QuickBooks Pro Desktop 2021 Bank Reconciliation Month 1 Overview. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars homepage. We currently have the open windows open. You can open the open windows by going to the view drop-down, selecting the open windows list. We're going to review the bank reconciliation process for the first month of operations. We will do 2 months of bank reconciliations as we did 2 months of the data input. This is good because the first month of bank reconciliation is often the most challenging one. It has more challenges, it has unique type of challenges for that first month of bank reconciliation. The second reconciliation has different challenges, but typically will be an easier process and will be representative of the normal process that will be going forward from that point. So if you're starting up the QuickBooks system, you're doing the first bank reconciliation and you're thinking, wow, that was more difficult than I thought it was. I do not look forward to doing that each month. Don't worry, because typically the second month should be a whole lot easier than the first month. So let's take a look at our objective, and then in the next presentation, we'll start to actually do the process of bank reconciling. So first of all, just remember what our end goal is to be tying out what's on our books to what is going to be on the bank statement. So to do that, let's open up our reports up top. Let's go to the company and financial. Let's go to the balance sheet standard. Balance sheet standard, I'm going to look at the end of the first month first. I'm going to do it in the range. So I'm going to display and go from 01/01/21 to 01/31/21. So the end of January is what we're looking for at this point in time. The first bank reconciliation is going to be for the end of the month of January. So I'm going to say OK. And so there we have it. So we have our GL balance as of the end of the month, as of the end of January. Now, note that when you have online banking, I often get questions like, well, I can check the bank anytime and I can get my balance anytime. Can't I just reconcile in real time? You don't really want to reconcile in real time, because what you want to have are those lines in time. You want to say, this is the specific point in time that I need to be reconciling from my books to the bank books. And the bank reconciliation, or the monthly statements, are the traditional way to do that and are good time intervals to do that. If you pick some kind of random time interval and try to use a running balance system, it's difficult to do because you need to know what the starting point is, right? You want to know where your last starting point is, and then you want to be able to move that forward on the next starting point. So that'll become more clear once we do 2 bank reconciliations. You'll be able to see how that works. Now, note this is going to be as of January 31st, 2021. So that means that you do want your bank statements, of course, as well. If you have online banking, you're probably able to download the bank statements, but you may not do that regularly, considering the fact that you can see the running balance. And you're like, well, I can kind of review the running balance. I don't really need the bank statements. But again, you want them to be able to reconcile on a periodic basis, on a monthly type of basis. So note that the end of the bank statement as of December 31st, you might say, well, wouldn't that be exactly what I have in my books? In other words, if I recorded everything correctly, you would think that this amount in the books would tie out exactly to what is on the bank statement as of the same point in time, as of the same date, considering this is an as of statement. This is a balance sheet number. Wouldn't it be the same? No, almost never will it be the same unless you are on unless you're depending on the bank in order to create your financial statements generally. Why will it not be the same? Because when we do our books, we're not doing our books being dependent on the bank. If I go to the home page, when we write, for example, checks at the end of the month for the utility bill, for our payroll, for the everything, the electric and whatnot, we're not writing the check and waiting till it clears the bank. We're not depending on the bank to create our books. We're writing the check and then we're recording it at the point in time we write the check. We're doing our own books over here, right? It just so happens that check is a cash balance account and therefore will come out of the checking account, and the bank will then have to do the accounting on their side as well to adjust basically the reverse side of things on for our checking account. So we're not dependent on the bank when we actually write the checks or when we receive the deposits. If we're getting a check, if we receive a check, we're going to put it in our system when we get the check, or when we get cash, we're going to put it in our system when we group the cash together. Then we're going to go to the bank and make the deposit. We're not typically in a full service accounting system waiting till it clears the bank before we make the deposit in the system. So that means that when we enter our information into the checking account, we know that it has already happened, even though it takes a little while. It takes a lag for it to clear the bank, especially checks. Because if I give someone like a payroll check, they have to take that check, they got to deposit it, then their bank has to talk to our bank in order to know from the banking side that it has actually cleared. So there's going to be a lag. There's going to be a time lag, especially for checks, but even for electronic transfers of maybe a day to 3 days before an electronic transfer goes through. So it's not going to be the same. So the process of us reconciling between the two will then, if we get it down to the penny, the completely accurate, then we know exactly what the difference is. And not only does that tell us what the difference is, what is outstanding, it also tells us basically that all the other transactions are basically correct, because I know what the difference is basically to the penny. That means that I have good confidence that all other transactions must be correct. I must be doing all the transactions correct if I can line up everything down to basically the penny. Notice if the bank reconciliation is off even by a couple dollars, the level of security goes down greatly, because that couple of dollars may be a result of 10 different transactions, deposits and checks that happen to sum out to a few dollars, right? So that lowers the level of assurance a lot. You want to get it as accurate as possible, and you should be able to basically get it down to nothing. You should be able to say exactly what the difference is, because it should be basically a timing difference, and it's just a ticking and tacking off type of process to do so. So here's an example of the end result. This is just an example of a bank reconciliation out of QuickBooks. It's not going to use the same numbers that we will be doing when we do the bank reconciliation, but the bottom line is the report will look something like this, where we have the cleared balance. This is the balance that's going to tie out to what will be on the bank statement. So these are the items that have cleared the bank. They have cleared the bank. And then this is going to be the book balance, the amount that'll be on our balance sheet. And then they'll tell us exactly what the difference is. So if you're getting an auditor, this is what the auditor wants, so these differences, to know exactly what the differences are, and they can go and verify these differences if they so choose. How would you verify these differences? Well, you need the detailed report, because we need to know what the actual checks are. The QuickBooks detailed report looks like this. It looks a lot more kind of intimidating, but the uncleared items here are the ones that we're looking for. And these are those 5 checks that are basically listed out. You can go to the February statement and see if they have cleared in February. And if they have, then you're just talking about a timing difference. And that's what we're looking for. If it's just a timing difference, that's what we expect. And if we can tell exactly what that timing difference is, we're doing that so that we can basically have verification not only about the bank balance at this point in time or just these transactions, but all of the cash transactions. And note that cash is going to be in every cycle that we go through, meaning when we look at the home tab, the cash is going to be part of the vendor cycle, even if we do the vendor cycle here, right? This transaction doesn't have cash, but this transaction will. So once we verify cash, we're verifying the vendor cycle to some degree. Customer cycle as well. This transaction doesn't have cash involved, but this one, this one's going into undeposited funds. This one, of course, will have cash involved. Therefore, when we verify cash, we're verifying to some degree the customer cycle. Obviously, when we pay employees and pay the liabilities, cash is going to be involved in that cycle as well. So by reconciling cash, we're reconciling to some degree the other accounts as well, even though not completely, because we're doing cash, which is a cash basis or a cash flow, rather than all the transactions of the books, which includes accrual and which will include non-cash transactions as well. So if we go back to the balance sheet, then our objective is to have this tie out to the bank account and know exactly what the difference is. So this is going to be our mock bank statement for the first month of operations. Bank statement will typically look something like this. The format might be different, but it basically has something like this, right? It's going to say, hey, here's the beginning balance. Here's the additions. Here's the subtractions of the accounts, the increases and decreases. And here's the ending balance as of the end of the month. And then we're going to have detail that will break out the additions and subtractions, including something like deposits. So these deposits add up to the total additions. And then here's all the checks and other withdrawals and whatnot, which are going to add up to the total subtractions that will get us to our ending balance. So what we're going to do in a bank reconciliation is we're just going to tick and tie off everything that's on the bank statement to what is in our books. Now, this is the process of reconciling, and there's a nice little kind of widget thing to do it in QuickBooks. I'm going to go into it. We're not going to start reconciling, but let's just take a look at the process. I'm going to go to the banking dropdown, and we're going to go to reconcile. And then I'm going to go to the checking account. We're going to say this is as of January 31st, 2021. Make sure to change this because it'll go to the last date that you entered, because there hasn't been a reconciliation prior to that. The beginning balance should show up at $25,000, but note that's one of the problems that often will happen, and we'll discuss that when you do your first bank reconciliation, that won't be $25,000 or won't match what's on the bank statement here. And then the ending balance is going to be this $89,335. So I'm going to put $89,335. I don't like to use the service charge or interest earned. I'll talk about that more when we get into the logistics of it next time. But let's go ahead and continue now. Again, we're not going to do the reconciliation. I just want to look at the layout of it. So here's our reconciliation process. This is basically the general ledger that's going to be laid out here. Now, as we compare this, this is the general ledger or GL account or transaction detail for cash. And you can even limit it to items that are before this date, so that can limit our data so we don't see everything happening in February and whatnot. And that can make it a lot easier. Oftentimes you might be entering data, depending if you're working in an accounting firm, you might be entering data for multiple months, and so you might have it to be reconciling like a whole year's worth of data. So it's really nice to be able to limit the data to some degree so that you can make the reconciliation easier. But then you're just going to tick and tie off from here to what's on the bank statement. So it's going to be a nice, easy process to basically tick and tie off that process. Now, the problem we're going to have, one problem with the first bank reconciliation is this $25,000 beginning balance. You might not have that, right? You might have, like if you started the bank account and you started it when you started the QuickBooks file, or you started using QuickBooks and then you started entering information into the bank account, then you might have a bank account that starts at 0, and that would be great. The beginning balance would be 0. You'd record the deposit into the bank and move forward from there. However, many people often have the bank account already set up, and then they start their bookkeeping system, even if it's a new company. So now you're gonna open this QuickBooks up, and you're gonna say, the beginning balance isn't $25,000. What am I gonna do? Because that's part of the process to tick this thing off, to tie everything out. This beginning balance is part of the thing you need to tie out. Well, there's a couple ways you can deal with that. Or the other issue you can have is like what we did. We actually took this information from a trial balance, and we took the trial balance number here, which we had to do in order to make the trial balance go into the system correctly. However, this number here is including outstanding checks and deposits that we're gonna have to deal with from the prior accounting system. So let's think about this situation. First off, if you didn't enter this into the opening balance and you started working forward, now you've got data into the system, you may not want to go in and now enter it into the opening balance. So one way you can deal with this is you can actually enter it into the register just as another transaction. And so instead of it showing up as the beginning balance here, you'll just enter it in the register as a transaction and check it off, and you will still be able to reconcile. So then you just want to recognize that that's going to be the beginning transaction. So the way you would do that is you'd go into banking, use register, and then you would enter this deposit just like you normally would. And if it's a deposit that you entered in the current period, meaning it's something that was going in there in January, because we're starting in January, then you would want to record it to the proper account, possibly owner investment. If it's something that you put in prior to January, and it's something that it was an ongoing business, meaning the business was going prior to January, it shouldn't be affecting the current period, then you might want to put it in there as of December prior to the current period, and then it would roll over to equity basically anyways in that case. So that's one thing that you can basically take care of in terms of this beginning balance if you don't have the beginning balance there. Now, the other problem you might have is that you enter this $25,000 into your opening balance because that's what was on the trial balance, but then you look at your bank statement and you're saying, okay, that doesn't match what's on the beginning balance on the bank statement. It does here, but you might run into a situation and say, I needed to do that to reconcile, but it doesn't match what's on the bank statement. And that's because of there was uncleared transactions. There was outstanding checks that were in play when at the point in time when you started entering the data into the current system. So this 25,000 that you put in there on the trial balance is including outstanding checks and or deposits that were in play. Now there's a couple ways you can kind of figure this out and deal with that. Note that if you go through the process of checking off everything that's on your bank statement to what's in your books as you move forward, what's in your bank reconciliation, you will most likely end up with a few transactions that are on your bank statement here that are not in your books. Why? Because they were uncleared transactions from the prior month, in this case in December, that are clearing now in the bank. They're clearing the bank in January, but you had them in the books because you actually wrote the checks in December in the prior accounting system. So once you tick and tie everything off, you'll be able to see those items. They'll typically be the ones at the beginning of the month that were actually transactions that were entered in the prior time period that you are seeing clear in the current time period. Now you can do a couple different things at this point. One, you could say, okay, that difference basically adds up to the difference in the beginning balance. I mean, you might be able to reconcile at that point because this 25,000 will and if you check, will be the difference, will represent the difference. However, it would probably be better to actually enter those items into the system. For example, another way you can go about this is if you did bank reconciliations in the prior month in December and you have a bank reconciliation like this. This isn't the same time period, but imagine this was a bank reconciliation for December of the prior month. You would say, okay, these were outstanding checks as of that point in time. They were outstanding checks we're imagining in December prior month, meaning they're clearing the bank statement this month, even though we wrote them last month. And so what you would like to do is have this information into your current system. So you could take those checks and actually enter them into your accounting system. You can go into your check register, enter them into your accounting system here, and then make the adjustment to the beginning balance of the 25,000 to cancel each other off. And that way, if you do it that way, then you can still tick and tie off the checks that have cleared. You can see them clear, and you can basically tick and tie them off, and your net balance should still be the 25,000 that's on your trial balance. It's just going to be represented by this opening balance transaction and then those checks that are basically going to be netted out that then you can check off and clear. Now, as you enter those checks, you don't want to enter them. You can enter them from the bank statement here, but you do not want to enter them as of the date on the bank statement because that would be entering them in January, in the current time period. You want to make sure to enter them sometime in the prior time period in December. It would be best if you had the prior bank statement to actually take these checks and use the actual date that they were written and then put them in your books as of the prior time period, because that will allow them to roll into basically retained earnings. They shouldn't be part of your current period income statement. You just want them in there in your beginning balance, but broken out of this net 25,000 if possible, so that you can actually check them off and do the process of basically reconciling by ticking and tying them off. So that's going to be one of the, those are the major kind of problems, that beginning balance kind of problem. Once that beginning balance problem is done, then the bank reconciliation is really easy because all you have to do is tick and tie off what's on the bank statement to what's on your books. And what you want to do is always be going from the bank statement to the books. So I'm going to tick and tie off, I'm going to look at the bank statement and then go to the books and see if it's on the books. So there's the 50,000. I'm going to go to our books and see if the 50,000 is here, check it off. Then I'm going to go back to the bank statement and then to our books. In other words, I'm not going from the books to the bank statement. I mean, you can start to do that, but you always want to think about going from the bank statement to the books. You'll start to get confused when you do this. It's kind of mind-numbing. You want to go from the bank statement to the books because everything on the bank statement needs to clear the books. If it's on the bank statement, it's got to clear the books, because that's something that for sure happened unless the bank is wrong, in error. And the bank is not usually in error. That we don't usually do a bank reconciliation to catch the bank errors, although we could catch bank errors, but those are fairly rare. We're usually there to catch our errors by double checking it against the bank, which is usually correct, right? So we want to, if it's on the bank and it's not on our books, unless we can verify that it's an error, then we need to add it to our books, right? We're gonna have to add it unless it's wrong, right? So if it's on the bank, it's not on our books, we'll have to add it, like we will for these two. Will not be in our books, and we'll see that. However, if it's on our books and it's not on the bank, then it may not be wrong. It's not like we did something wrong there. It could just be a timing difference. So we actually expect things to be on our books and not on the bank. That's why we're not going from our books to the bank, because we're expecting things not to be there. We're going from the bank to our books because we're trying to find everything on the bank on our books. Once done, we will have things on our books that will not be on the bank. What will those things be? They'll be the outstanding checks and deposits. Those will be the reconciling items that when we generate a report with this, after we do this process, will result in these kind of items in our bank reconciliation when we actually create the bank reconciliation after doing the process of reconciling. Okay, so hopefully that made a little bit of sense here. And next time we're going to go through this and we'll actually start doing a bank reconciliation.